¡Y la encontré! ¡Eso! ¡Eso! Y yo con el bañador, con la máquina. ¡El cocinero!
Coming up today, stocks experience a sharp sell-off as the government opens back up. What's behind all the selling? The importance of December the 10th. AI anxiety reaches fever pitch. What could be the next catalyst? And are you being goosed by the market on a day like today? There's blood on the street, guys. Let's go. And welcome back, guys, on a bit of a sharp sell-off today. Across the board on risk assets, growth stocks and crypto, along with the indices in general. The Russell 2000 down almost 3%. Semiconductors and tech stocks being hit hard, with some of the biggest names out there falling quite sharply. Tesla down 6.6%, and the AI trade especially, Palantir and others, coming off quite heavily today, with some broad-based selling across the board. And so in this video today, we're going to take a look at the possible causes behind this sell-off and what to expect next in the stock market. And if you haven't already, make sure to smash that like and subscribe button so these videos show up in your feed every day. Stay up to date on the market. And in case you didn't realize, the title of this video is sarcasm. I don't advise anybody to freak out and sell everything. In fact, I just bought the dip on one of my favorite stocks today, so stick with me and I'll reveal that later on, along with my bullish thesis on it, which I'm sure you'll find interesting. And just looking at the main indices, S&P 500 still just sitting above its 50-day VWAP, but once again, it was high beta, small cap growth stocks taking it on the chin. In fact, looking at the newly created meme stock ETF, it's now down more than 43% just in the last month, as it has been quite a washout of retail traders in particular, including Bitcoin, now down more than 20% off recent highs, meeting the technical definition of a bear market. And so it's interesting timing, isn't it? Just as the government reopened, stocks sell off sharply after entering the longest shutdown in history, 43 days. So what is behind this sell-off, apart from some traders just being liquidated, bit of fear setting into the market? Well, I think it's mostly anxiety now that we're going to get a barrage of economic data around, namely inflation and the jobs report. And as usual, the market hates uncertainty, but just looking at trueflation, I don't think there is cause for concern. Real-time prices in the economy are still tracking at 2.5%, but no doubt the jobs market could still be weak, but the stock market cares more about profits than jobs, as we do have some big structural shifts in the US labor market. On top of that, doubts are being cast about whether we're going to get another rate cut next month, as quite a few Fed members are pushing back on doing another cut. Some of them saying we should stay on pause, but we've actually got a few saying they should do half a point cut. And that's why options traders are pricing in December 10th when the Fed meets as the most volatile day we're going to get for the rest of this year, looking at options premium. And interest rate traders as well, now given a 50-50 probability on whether we get a cut or not. When the Fed meets for the last time this year, next month, it's now a coin toss, which is not necessarily a bad thing, because if they do stay on pause, that would mean there's some resilience in the economy. Maybe the jobs market isn't all that bad, because looking at market expectations of inflation, they've actually been coming down these past few months. And so I think uncertainty over whether we get another rate cut, over what inflation and jobs data is going to come in, as the market's kind of been in the dark for 43 days, is no doubt stoking fears, along with the widespread media reports of the big short investor Michael Burry disclosing short positions in Nvidia and Palantir. Interesting to note, he just closed down his hedge fund, no longer looking to report his positions to the SEC. And it was actually misreported that he had almost $1 billion short on these AI stocks, when in fact he came out and clarified it's actually $9.2 million. Quite a big difference there. And they are in very long dated put position. Palantir, 50 strike, expiring in 2027. And so no doubt that's added to AI anxiety. It's pretty much been present this entire bull market, as all the capex spending is constantly being brought into question, whether it's actually going to deliver returns or not. And that is for sure showing up in multiple sentiment indicators. The fear and greed index now back into the extreme fear zone. We just got the latest II investor sentiment survey. Sharp jump in bearishness, 49% versus 31% bulls. We haven't seen that sort of tilt in quite a few months, actually. And I'm seeing it all across my timeline as well. Thought I'd share a few of these posts with you guys today. It was fun while it lasted. Looks like we are entering an actual bear market now. Another person saying you should buy a bunker and stock up on beans. Another one, markets are flashing major warning sign. Anybody else completely tired of crypto? Crypto is done. And this guy posting a photo of the band playing on the Titanic ship. Another guy saying when you finally realize the year-end market rally is never going to come. A lot of traders are in despair out there. But if you look for it, you'll always find a reason to sell stock. The setup is never perfect. If it is, you're probably closer to a top. But I don't think there's any big serious headline to justify a bear market. In fact, I think the fundamental setup is great. We've had a good flush out. Fear has risen. Doesn't matter whether the Fed lowers rates next month or not. We're going to get a dovish Fed chair come May, who's almost guaranteed to lower rates. Corporate earnings at all-time highs. The Fed boosting liquidity. And typically when we see a lot of bears, the forward returns are pretty good. Just like this chart shows right here, the S&P 500 500. When there's more than 49% bears, well, the S&P is within 1% of all-time highs, which is actually a really unique setup. We've only seen it play out once before, as it's very unusual to get this amount of bearishness with the S&P sitting at all-time highs. And typically after the government shutdown ends, that's also bullish as well. Even in the short term, stocks are usually higher a few months later. And we've got a big event coming up next week. That's Nvidia's earnings, the leader of this bull market. And they actually just recently disclosed visibility into more than $500 billion in revenue through the end of next year. That is a monster number. And I agree with this point here. There is a lower bar for execution since there's so much fear and skepticism over AI infrastructure spending and the demand for it. But like we've been hearing from AMD, Cisco, Oracle, they're all bumping up their growth forecast into next year. They can't sell enough GPUs. They don't have a demand problem. They have a supply problem. And AI is unlocking record profit margins. They've been up and to the right. US stocks have never been more profitable. They deserve a high multiple and valuation. And I think another interesting point many people are missing is the government's finances are actually improving. We're starting to see consecutive months of a budget surplus. In other words, the US government's bringing in more money than what they're spending. In fact, almost $200 billion surplus in September. And what that does is open the door for more fiscal stimulus, more government spending, and especially post-Mamdani, with fears over the rise of socialism, I think this admin is going to do more and more stimulus to help those that are struggling. Low and middle income consumers, there's already plans of a $2,000 stimulus check. I think they'll reinvest all the revenue from tariffs and some back into the economy, and they could very well unleash a tsunami of fiscal spending in the coming quarters as the midterms must be defended. And that, my friends, is very bullish for the stock market. Plus, on many measures, we haven't reached those crazy heights that we did see from the late 90s. Looking at a chart here of the amount of standard deviations above the trend line using Bollinger Band, we actually reached 4.1 in the late 90s, consistently above 2 for quite a few years there. Currently we're at 1.7, and we haven't really seen that crazy melt up that we typically see towards the end of a bull market. I believe the ingredients are still there for it, and this flush out can make for a good buy the dip opportunity, as the AI boom could very well match the internet boom and potentially even go further. Looking at a chart here of when the first web browser was really back in late 94, Netscape Navigator. I remember using that myself. Really kicked off the internet boom, and if you're liking that with the release of the first AI chatbot, GPT, back in late 22. We're actually trailing where the internet boom was through that period of time, and if we were going to match the internet boom, we could actually have a few years left in it, which I do believe is still very much likely. But just like the internet boom, there were sizable corrections and pullbacks and volatility along the way. And just looking at market internals, they haven't really broken down. The percentage stocks above the 200-day moving average, still at 56%, hasn't made new lows, and the amount of stocks hitting new 52-week lows hasn't broken out either. 61 on the NYSE today and 89 on the NASDAQ. Did see a bit of a bump up in the VIX today in right around 20, but VIX term structure still very much in contango. Option dealers not pricing in heightened volatility anytime soon. Bond market volatility is still downtrending and below its 200-day moving average. Bond yields are not doing anything crazy. They're not spiking, signaling inflation, higher financing costs, nor are they nosediving, signaling recession. And credit markets are still functioning quite well. High yield credit spreads at 3% aren't showing any red flag. The US dollar is stabilized, and so has crude oil, which again I would say is in a sweet spot. If it were diving hard, that would signal weaker economic growth ahead, and if it was spiking, well, that puts downside pressure on consumer spending and the economy at large. So I think oil hovering right around $60 a barrel is quite a good level for the market. And just looking at Nvidia, the market leader, it too's holding up pretty good going into earnings next week. And in fact, we've got the second largest stock in the market now, Apple, actually holding up really good, and Microsoft still consolidating, but they did just come through with a good quarter like most of the market. Earnings are very strong at the moment, but we are seeing a good flush out in high beta small cap growth stock. Looking at a few here, Serve Robotics, New Scale Power. Like a lot of these stocks, they are technically oversold. We're getting bullish reversal signals, and today to me looks more like we're getting closer to the end of this flush out. These big double-digit down days on no real big headlines. The market's just worried about what economic data is coming, but we can see inflation is still quite tame. The market's pricing in inflation expectations to be quite low, but no doubt we did have a good run up there for a few months. No surprise to see some profit taking, which may be feeding onto itself into this bigger pullback. Hitting some of the most sensitive sectors the hardest. Quantum computing. Favorite here, Rigetti, down over 56% from its recent high. And like I said, the AI trade really took it on the chin there today. Stocks like CoreWeave, heavily oversold. -17 on my DSI is quite a low number. And rare earth stocks as well have had a big pullback this last month. But you're going to see that from time to time. That's normal in a bull market and uptrends. I'm still holding Idaho Strategic Resources long. And the stock I alluded to at the start of this video that I actually bought the dip on today, one of my favorites long term, Richtech Robotics, with it too pulling back over 50% from recent highs. As I've been saying the past few months, expect some volatility and pullbacks. 30, 50, even 70% pullbacks for these stocks are to be expected. You want to make big upside, you got to be able to handle a little downside. There's no reward without risk. It's not always smooth sailing. Sometimes there are some rough seas to navigate through. But in addition to being technically oversold, got some reversal signals. Now on oversold levels on the DSI, market cap only 646 million. The reason why I actually added to my long-term position in Richtech today is because I see it as one of the few true US listed pure play high beta ways to ride the coming robotics wave into Tesla's humanoid launch next year. Richtech is not a science project. They already have over 450 robots deployed in businesses across the US, from delivery bots like Medbot and restaurant servers like Maitre Plus. They're pushing hard into beverage automation with their Scorpion robot bartender, where they've just signed a distribution partnership for 500 units over 5 years, and they're taking that globally, integrating with Nvidia AI chips. They already operate in ghost kitchens in 20 Walmarts. And just a few weeks ago, they unveiled Dex, first mobile robot that can work in a number of different settings. And even though it was met with underwhelming response from the market, I still believe it holds a lot of potential and real world function. And so Richtech sits right at that intersection. AI-driven robots for hospitality, healthcare, logistics, cleaning, with their unique robotics as a service model that if it scales could turn each install into a long duration, high margin software and service stream. And so for me, Richtech is my speculative bet to gain high beta upside exposure on the idea that as Tesla's humanoid story heats up going into next year, capital will look for other pure play robotics names and companies with real deployments, real contracts, and Nvidia powered platforms. So no doubt it is high risk, still a small business, very volatile, but a lot of people out there are concerned with protecting their downside. I'm more concerned with gaining upside exposure and riding the inevitable wave. Like I said, technically speaking, it's had a big pullback here on really low volume. And typically markets like to go where they find the most volume, which we've seen every time it has a big update. It attracts a lot of participation in the market. And so this is the first time I've bought the dip in Richtech since back in July. And if it dips further, I very well may add some more shares around the 200-day moving average, currently 279. So again, it's not a swing trade. I plan on holding it for a couple of years, potentially longer, if the business keeps developing. I think on speculation alone, it could reach a market cap of 3 or 4 billion. And if they are actually able to scale the business up in the real world, well, then the sky's the limit. Because the more and more GPUs and AI advances, the better and better their robots will function and start replacing humans in labor-intensive roles. And Richtech is just one of many stocks that I own. I still think, no doubt, the leader in robotics going forward will be Tesla. But right now, they're not a pure play in robotics, as the majority of their business is still electric vehicle. The future is going to be more about robotics and the humanoid, which could very well be in consumers' homes by this time next year. And with lower rates, a very bullish government, increased fiscal spending, I still think next year has a lot of potential, in addition to the excitement towards the release of the humanoid, potentially the biggest product of our lifetimes. Otherwise, like I said, there's been a pretty good flush out in all these smaller names, but we are heading into a bullish seasonal period into year end, and we are seeing some elevated levels of fear out there, just like I showed you earlier in this video. And so in my opinion, it doesn't matter whether we get a rate cut next month or not, pretty much guaranteed to get some next year anyway, which the market should like. And I don't believe the headlines really justify this sharp sell-off. And that's pretty much a wrap for the daily market review today. Thanks very much for watching to the end. My name's Jared, and I'll be back again this time tomorrow. Cheers.